Hi, future financial gurus, and welcome back. Ever wondered about that one magic number that can predict if an investment will make you filthy rich or just break even? In this video, we will peel back the layers on the internal rate of return or IRR. Starting right now. Before diving to the main topic IRR, we just need to know the basics like discounting. What is mean by discounting? It is estimating the future outflow or future inflow. Together we call as future cash flow into current terms. That become more easy for the calculations. Example, 1 meter plus 1 kilometer is what? Isn't it 2 kilometer or 2 meter? No, right? So the 1 meter plus 1000 meter is 1000 and 1 meter. Here we converted the kilometer into meter and the answer is also in meter. So if the future money have to convert into present value, present money, that make the comparisons and everything more easier. The other another course is comparison. For comparing, we need to discount. Today, investment with future inflows, we must bring everything to a common ground. Did IRR have any good formula for direct calculation? No, that's the dilemma we are solving in this session. IRR is the discount rate that makes the net present value or NPV of a project exactly zero. In simple words, IRR tells you the expected compound annual rate of return the project will generate from its own cash flow. It answers the question at what interest rate will the present value of future cash flows exactly equal the initial investment. So, did you understand what is cash flow? Cash inflow and outflow is exact money comes in by the investors or other stakeholders and goes out by purchasing respectively. It not include any accruals like debtors or creditors or any other depreciation. IRR is forming when the net present value is 0. Now look to the equation. NPV is 0 and it is equal to the sum of CF0 and other net cash flows. The CF0 means initial investment. It will be always negative and it is added to all other cash flows. CF means cash flow and it is generally calculated per year. So N is the project life. So this is just an IRR equation and there is no direct algebraic formula to solve for IRR when cash flows are uneven. It is found by a trial and error interpolation methods. Theoretically, these methods are superior and also it is represented in percentage. So currently the managers use it widely and using the financial calculators or Excel IRR function, we can easily find the IRR. So in this equation, did you see the IRR? That is the small r and it is in the denominator. So whenever the power increases due to increasing in the project life, it become a polynomial equation. So for finding 25 years IRR, we have to sum up and before that we need to solve the polynomial equation for a plus b all raised to 25. And not only that, from this equation it is very difficult to separate the r alone. Here unknown variable is in the denominator. When the uneven cash flow came, like each year the profit rate is different. There is no direct formula for solving this polynomial. Multiple IRR can come. There's a chance for the multiple IRR for a same project. So we fix this issue by trial and error method or interpolation. Let's explain the trial and error method through a simple question. You are planning to buy a new X-ray machine with initial cost of 1 lakh which going out from our pocket. So we expected the profit from next 3 years as first year 40,000 profit, second year 50,000 and third year 60,000 respectively. Bank loan is 12%. We are going to find if we calculate profit for 3 years, totally what percentage will get returns, or what is the profit percentage, or what is the IRR in present terms. Do you know, in some competitive aptitude test, we need to find the answer by checking with all options. That is this simply the trial and error method. Likewise, we need to guess at a first for a proper discount rate. First, just put any percentage for R. Example, if we are expecting the 20% profit and discounted it due to value of time inflation and by considering opportunity cost and for the sake of comparison, then the next step is finding the net present value. So we already know that the importance of discounting, converting into present value. So for uniforming all the cash flow units. Then how to find net present value? Before that, how to find present value? So there is a beautiful equation like cash flow divided by 1 plus R all raised to n. Here, if the cash flow is 1 rupee, then after 1 year, the present value factor shows that what will be the present value of that 1 rupee after that 1 year. And if we are expecting a 20%, the smaller here will be 20%. That is 0.20. And for the first year, the power n will be 1, and for second year, the n will be 2. Like that, it will go. So, if we know the PV factor at 20% discount, then the PV factor will be 1 by 1 plus 20 all raised to 1. That is 0.833. That is the PV factor for the first year at 20%. Then for the second year, what it will be? 1 divided by 1 plus 0.20 all raised to square. So 1 by 1.44, that is 0.694 paisa. That means after 2 years at 20% discount, the value of the present value of that 1 rupee reduced to 0.6944 paise. Like that, for third year, if we calculated, we will get 0.5787 paisa. If in the question the PV factor is given, it is very easy to calculate the PV of inflows. We have in the question 40,000. So for the first year, the 40,000 into PV factor for the first year, that is 0.833, plus the second year expected profit is 50,000. Then it is multiplied by the second year PV factor, that is 0.6944. We will get a value. It is sum on with the third year. Similarly, then we will get 1,02,774. Then we are going to find IRR. Actually, it is not at NPV is 0, but NPV in different cash flows. Actually, IRR is the present value of net cash inflow minus the present value of net cash outflow. Here inflow എന്ന് പറയുന്നത് income or profit generated, and outflow is what is gone out from the hands of investors. What is spent for this equipment, what we lost, that is the outflow. But what we generated is inflow, that the expected profit that's all are inflows. So let's find the IRR here. So in this scenario, 20% of discount, inflow minus outflow equal to outflow is the invested 1 lakh rupees and inflow is 1 lakh 2,774. So when we decrease it, like inflow minus outflow, we will get 2,774. It is a positive value. So what we will do? We didn't get 0 as IRR. because we guessed a discount factor as 20%. That was not an exact value. We want a precise point of value of IRR, and if NPV is higher, the IRR must be greater than 20%. That is the inference. We get the inflow minus outflow as a positive high value 2774. So we need to increase the 20%. Then we tried for a higher discount rate as a 22% in search of IRR. Again, we need to calculate net profit present value. But while we calculated again, what will be the equation for the present value factor for 22%? That is 1 by 1 plus 22 all raised to 1 for the first year. Then power is changed up to 3 where, and that is the assignment for you. You just do and find what will be the present value factor for first year, second year and third year for the 22%. Then we find the net profit present value by multiplying with that expected returns like 40,000 into the present value for factor for the first year, then plus 50,000 into the present value factor for the second year, plus 60,000 into the present value factor for the third year that you find out. So we will get a negative value. So the negative NPV shows that IRR must be less than the 22%. So where it will be in between the 20% and 22% will be the profit percentage, where the net profit value, net present value is 0. Finding the exact IRR value, the method interpolation is followed. In interpolation, the equation will be like IRR equal to L plus NPVL by NPVL minus NPVH into H minus L. Here L equal to lower rate, that is 20%. H is our higher rate, that is 22%. NPVL means the lower rate profit, that is 2774, and the NPVH means the profit for higher rate, that is the negative value 576. While applying the formula, there is a step by step for mark process. For that, first find the difference of NPV in the denominators. So 2774 minus the minus 575, we will get 3349. Then the ratio of NPV, that is NPVL divided by this difference. So 2774 divided by 3349. So we will get the ratio value as 0.828. Then converting this to percentage by multiplying the differences of percentages, like 22% minus 20%, that is 2%. Then multiplied with that 2%, we are converting our ratio into percentage. Then adding this to our lower percentage, that is 20, because our IRR value will be above 20. So we are adding this value, that is 1.656% with this 20, the lower percentage. So we will get 21.656%. That is the IRR, means net present value is 0 at a discount of 21.656%. What is the power of IRR value 21.65? This make the go or no go decision. If the bank loan is 12% and the internal return rate is 21.65, that is the profit percentage is greater than the bank loans. Therefore, we can accept this project of buying X-ray machine. If the bank loan is greater than IRR or profit percentage, it better for no-go decision, because bank loan is higher Bank loan 25% and IRR is 21.65%. There will no profit generation. If at 21.65% of bank interest, the project exactly pays for itself. No profit, no loss. It's like break-even point, but at higher risk. Finally, are some critical IRR applications for hospital administrators. One is for capital investment justification. Hospitals are highly capital intensive. For justifying higher cost equipment such as MRI, CT, AI diagnostic tools, robotic surgery machines, determining multi-crore worthiness. Next is risk mitigation and uncertainty. In hospital, handling variance in patient volume, countering operational inflation, volatile interest rate, rapid technological obsolescence, and the cash inflow come from the patient revenue, insurance, Ayushman Bharat, etc., often uneven and uncertain. IRR helps quantify whether the investment will pay for itself at a rate better than the bank loans or grant. Next is resource prioritization. Example, if we find IRR for dialysis wing as 18% and cardiac wing as 22%, if our budget is limited, opt for higher profit percentage or IRR. That is also called capital rationing. When the limited budget, IRR plus profitability index help rank competing projects. Example, a new cancer center versus dialysis unit. It is regulatory viability, NABH, biomedical waste norms and patient safety add a non-financial cost, right? So IRR forces administration to ask, even after all regulatory expenses, does the project still give a good return? Another important view is, shareholders or trustee wealth maximization. Private hospitals and trusts use IRR to justify investment to board members and donors. So, IRR tells us the strength of our project. As administrator, it ensures we don't just spend money, but we invest it wisely. Thank you.